Hello and welcome to my very special guest today. I'm super excited to have Melissa Fisher back with us. Welcome, Melissa. So I love chatting to you.
Oh, it's amazing. Thank you so much for having me back on. It was so exciting after the last one. When I got the call, I thought, oh, absolutely, we're going to make the time for this. Phenomenal. Thank you very much.
Now you're doing some very exciting stuff at the moment that we've been chatting about, and we can touch on that in a minute. And we've been chatting about all of these exciting topics to speak about. But I think the biggest thing that we're looking at the market at the moment and how people are relating to interest rates and versus yields and buying. I find that quite a lot of people have kind of got a little bit nervous. They've pulled back a bit because the interest rates are a bit high. A lot of people ask me about that, and I say, well, think about the big investors. What do they do when the market is nervous? They go out there and they buy like crazy.
Yeah.
Okay.
It's perspective, isn't it? And it's understanding how the dynamics actually work. And you're very right. People have got nervous. They're a little bit unsettled with interest rates going up. We say factor it in,
Yeah.
right? This is where you've got to start understanding how the market actually works. And yeah, you watch what the big guys are doing. They're buying a lot at the moment.
Oh
Yeah.
man, they're going crazy. I'm loving the market at the moment because I'm seeing properties that have been on the market for like 12 months, 24 months. They're all falling over and they're coming back in. Now they're
Yeah.
coming in at realistic prices. It's
I
like,
know. I
absolutely.
haven't seen so much opportunity in and I know we said this last time, the opportunity is crazy, but it's just like, wow. And it's been a little while now. And like you said, there's been things that have been on the market for quite some time. They're not selling at the escalated rates that people thought they were. So they're back in at a realistic price point. And this is what people should be looking at. They should be watching this and understanding when the right time to buy is and understanding the values of things as well, being able to create those realistic values and time to jump in and purchase their next big deal.
So now's the time.
I know. It is. There's so much opportunity. It's crazy. So it is absolutely. I totally agree. Yeah.
So, Melissa, we're going to chat about a couple of things, and one of the things that we were talking about is the difference between buying a property for $1 million versus $5 million. Okay, and I know there are a lot of investors out there that are sitting on a pile of equity, and they're going, I don't know if I should spend it. Should I be spending it right now? What do I do? Do I buy a property for $1 million, or this property can basically afford me maybe a 3 or 4 million property? Do I buy a property for maybe 5 million? Okay, I'm pushing the number. So what I wanted to do with you is let's have a look at the difference between buying a property for $1 million versus buying a property for, let's say, $5 million. I'm pushing the margin there a little bit because I
That's
think
all right.
those people that are sitting on $2 million worth of equity, and I know there are a lot of them out there because your
Yep.
your property, the values of your properties have gone up immensely, and you've got this huge big stash of equity that you're sitting on. To me, it's burning a hole in somebody's pocket, and it must be yours. So I always say, don't work for your money, make your money work for you.
Vote for you for sure. Definitely. Definitely.
So, what do you think the difference is between that 1 million versus 5 million?
I got to sit there. I so wrong person to ask. I love the $5 million property, right? There's a few aspects to it, but the first one I want to touch on is that $1 million price point. Most people can understand that. Most people are comfortable with that level of numbers, right? Of dollars. When you start talking in the millions and millions, you feel the fear factor creep in. Okay, so not a lot of people are instantly comfortable with dealing with those sort of numbers. So first, people have got to understand that, understand where their comfort zone is, and break the barrier of we're used to smaller numbers. It's only another zero, right? So let's understand the value of that and what it's actually going to do for you.
Yeah.
Right. And then, I look at $1 million property and say, first, everyone in the market is looking at the $1 million property. So you're now in a pool of a lot of people that are going, this is the one thing that I want, versus working at a higher level and understanding you're working in a smaller pool. You don't have as many people as competitive as chasing that same product.
You know what the statistics are? The numbering statistics are between the $1 million property. So the barrier is 800,000 to about 1.5 million. You've got
Yeah.
53% more buyers in that category than any other category.
Yeah.
53. So you're competing against 53% competitors in that
Yeah.
category.
Absolutely. Yeah. So that's tough in its own right because there's opinions that are thrown around, and then there's the pressure behind making a decision. And for a lot of people that are not commercially orientated and don't understand the negotiation around it and how to buy yourself some due diligence time, get caught up in the pressure of making a decision. And it's a big decision to make around spending that kind of money when you're not used to it. So it's a pressure position to be in at that level to start off with for $1 million property before we even look at the property itself, right? You've put yourself on like a pressure cooker. I like to think if you are in a good situation with a fair bit of equity, we'd take ourselves out of the pressure cooker and start looking at a higher end product, a something that is at a higher price point, but what does it bring back to you? What does it deliver back to you by way of return?
Well, I
So
want to ask you, you said something about the pressure there, okay? Do you think that what you're suggesting is that the pressure is less at a $4 or $5 million property?
definitely, you've not got as many people there that are poking for and chasing, and the competition is not as high as what it is in the
Okay.
million dollar range. And again, one thing and from my experience, what I notice is most people are coming out of residential, going, I want that higher return, I want a different product, I want something that's going to work for me, but they still caught up in a residential mindset. Everyone understands what a house is. So it makes sense to them. When you put them into a commercial realm when they don't have the understanding themselves, it's quite a different game and they can get caught up in the residential mindset in a commercial world. Mm,
And that is
it's
that is most definitely, I mean, that is probably the biggest barrier to entry into the commercial world. It's just learning to understand the seven elements of commercial versus the two elements of residential. I mean, I say that all the time. But now I want to just speak a little bit more about the pressure and about the numbers and the difference of, let's say for argument's sake, somebody's got $2 million. Okay, $2 million in equity. We've got a lot of people that have most definitely got that in their homes, which means that they can afford a property of around about 4.5,
Yep.
edging on 5 million, depending on their serviceability. Okay, we were talking about pressure. Okay, we understand that in that sector there are fewer players, so the pressure on finding a decent property is a lot easier. Let's say in that
Definitely.
financial pressure. What do you think about the financial pressure? Because if we look at the numbers,
Yeah, I know.
property of about $1 million at 6 to 7% is going to give you between 120 to $140,000, okay, of rental income, versus a property that's at 4 million, edging to 5 million, is going to give you a return of 250 to 300,000 one off. Okay. If you're buying four properties, what's the pressure? What's the outcome? What's the cash flow?
See, there's the thing, right? When you look at that right from the very beginning, you're going to go and buy four properties. So you're putting yourself through the process four times. You've got four lots of fees and charges and everything that you're going to pay versus let's focus on one really good property that's going to give you everything you need because you've got a nice refined scope of what's going to work for you. You know what sort of income returns you're looking for. You know what sort of asset class that you align with, that you gel with. Let's find one that suits. Go through the process once, get that nice income return that comes in off it, that hits your bank and you're having pina coladas on a beach somewhere quite nicely. I also go back to the management of it. Okay. So you're going to have one larger property that's going to be under management with someone that's experienced in what they're doing versus four that are under management in maybe multiple different places. So now you're dealing with other multiple managers. There is more going on with four smaller properties, albeit it feels safer. There's more going on with that than what there is with the one larger property. If you've worked with the right people to ensure the product that you're buying at that higher price point is a good product in the right area, and we've looked at all of the dynamics around leases, multi-tenants, all of the things there to make sure you're buying well. Because personally, I don't care if it's $1 million or it's $5 million. If you buy the wrong asset, it's never going to work for you. If you
Correct.
buy something in the wrong
Absolutely.
area, it's never going to work for you. So we've still got to be smart no matter what the dollar figure is. Then we've got the fundamentals right.
Yeah,
The right location, it's paramount. It always has been.
absolutely.
And the
The three
correct
P.
asset class.
It's the three P's:
Yep.
position, position, And position.
and position. Exactly. Exactly.
But
Right. So,
you've said something very important over there that I just want to go back to. Now, four properties is mitigation of risk because you've got and you can stage your leases and that sort of thing. However, if you're buying a property of let's say 4 or 5 million, it doesn't necessarily need to be one rental. It doesn't necessarily need to be one tenant. And I think the fundamental difference is so that people understand that if you do have one tenant, there are a lot of areas in the lease, let's say, I'm going to focus on the lease,
yep,
where if you've
yep,
got one tenant in particular, you've generally got about 6 months to re-tenant that property. So
yep.
the tenant gives you 6 months head up to advise that they're going to be vacating the property. And generally, in my experience, and I don't know if you would resonate, the tenant would generally start talking about this almost a year before.
Oh,
Because if you think about the
absolutely.
size of
Yep.
moving a business that is that scale, it is
Yep.
a huge machine to move.
Yep. It
That's the
is.
one thing. And the other thing is you tapped on it, multi-tenanted properties in the region of 4 and 5 million, easy peasy, loads of
Yeah.
them.
Yep.
You
And there absolutely is. It's really interesting. I've got a client at the moment where we're just going over his portfolio, and yes, he's got some nice chunky deals in there that are single tenants. Now, what he's realized though is when you start looking at them, they're listed companies. The yield's not as good. Yes, they are very, very low risk. The likelihood of them shifting in the terms of their leases, which are very, very long leases, are minimal. So we've gone for a very low risk product. But we see that at the back end of yield as well. The yield is nowhere near as high as what you would like, especially when you're looking at interest rates you're paying versus sitting on the little shopping center that's got 12 shops in it that's returning 15% quite easily. You've had some vacancy going in.
Well, if you've got a couple of those, can I have them, please?
Actually, I've got a I've got a client that did one so well. It's regional. Yes, well, you look at the risk you take on, and it was cheap for her to buy into, but she bought vacancy and leveraged the position to get a great yield off the back of it. Loved working with the tenants, understood what the tenant mix was by the time she'd finished it, so learned a lot along the way. Multi-tenancy, so you can't go past it. For
No,
risk mitigation, you can't go past it. One of the biggest and highest uplifts you'll get is buying vacancy if you can tolerate that and you know you've bought in the right area and you've done your research and due diligence on the people you're working with to assist to get tenants in. You've factored it into your time frames.
so
Can't go past it.
my question to you is, can you find these properties in the region of about 4 and 5 million, which are multi-tenanted, industrial, mainly industrial? I mean, there's heaps of retail around. Retail's a no-brainer, but multi-tenanted industrial that can give you the same and if not better returns.
Well, the thing is, again, I say you can, and I look at when I say regional areas, we focus a lot on regional growth areas. So, where are the biggest regional growth areas in each state? And then we start looking at this because while there's residential growth,
So,
we know that there's going to be industrial, commercial coming up behind it.
yep.
So then we start looking at what's going on in that space because that's the time you want to get in. We know we've got the confidence of the market because the residential market's been moving. So you're coming in with a lot of confidence and a lot of demand behind it. So to be able to buy those with some vacancy in places is a perfect
Gold.
scenario because you've got the people wanting to come in, you've got businesses that want to be there. So yes, it's there, but you've got to know where to look. A lot of people hang towards the outskirts of metro because it's comfortable for them, it's safe because there's already numbers there. But your challenge there is the price points are a lot different when you're looking metro to some of the bigger regional areas. State governments are backing regional areas. So again, it's another confidence thing that's going on. Where are the states putting their money? What are they supporting at the moment? And for me, they're the factors I like to look at because that's confidence. If the state government's driving industry in a regional area, I want to know why. Like, why are they prepared to back it? And if they're prepared to back it, I'm interested and I want to go and see what's going on. And generally, they've had a push for residential and they're going, wow, okay, we've got to actually back this up now with the businesses to support our new residents. So when you understand the flow, I think it just makes sense. But for the audience,
That's what you've just said. There's full of gold nuggets because you're talking about where government's spending. You're talking about gentrification. Where there's residential, there's going to be commercial right across the board, all different types of commercial. And those are just green flags leading you down the right path in the right direction. If you look at just those two things alone, I think you're halfway down a winning streak, let's say. The thing is to find the properties, to have the grit, to have the knowledge, to have the know-how in how to leverage those deals, in how to work with the tenants, to how to work with regional people in those areas. You know, it's
There's
all
a
those
lot going on. And if
yes.
I to be really honest, for the majority of people, they don't want to go and do that work. Right. So
No.
I'm very okay to and the many people I speak to go, this is an asset that works and this is why it works. Right. This is what's going to give you a great return and this is why. And I understand you're not going to go and do the work yourself. You need a
Yes.
good buyer's agent that's going to do it for you. And you need to be very specific when you're talking to a great buyer's agent to go, this is what I'm looking for, because they can only help you if you give them the information that they need.
Do you know of any good buyer's agents?
I've heard of I've heard of one. Yeah, I know her name. I'm sure it'll come to me. It's also, Mish, it's gold in the industry because so many people don't have the time and they don't have the experience or expertise, or they don't have the risk tolerance. The tolerance itself to go out there and say, I'm prepared to put the effort in and understand it. And it's where people like you come into play. And it is incredible part of an industry because without it,
No,
people don't end up with the good assets they end up with.
no,
Okay.
they
So,
don't. I want to tell you about a little acquisition that we're doing at the moment. It is recycling, and the tenant that is currently in there has been there for about 3 years, and he's just signed another nice long, and it's with one of the national recycling companies. And the seller has been I get that and this often happens. There's conflict between the seller and the tenant because the tenant has signed a lease under the premise that he'd be able to buy the building.
yeah.
However, there's no ways that he'd be able to afford the building. Okay. So I arrived there this morning, in fact, and went to meet with tenant, the building and pest, with the valuer, with the agent, and I'm telling you, it was like there was a huge black knife between myself and and the tenant. And the agent was like really saying, no, you can't speak to him. And I said, hey, you know what? In the essence of transparency, this is not the way we do things, okay? Because I am going to speak to that tenant
Mhm.
either which way. And I could see he was feeling very angsty about it. Anyway, turns out, long story short, the tenant, there are a couple of things in the tenancy that he's not happy with the building. The seller hasn't been doing the repairs and maintenance. All a long story short, by the time I left there, I was having a great friendly chat with every single one of those blokes. And
Yeah.
that is the magic of being on site, meeting with them. And I can tell you, we've got a tenant who is celebrating us taking over that property.
Yeah.
You know,
You know what? You can't go past that. Working with them, you say transparency, absolute good communication. There should be nothing any different to that when you are creating an outcome for a project, irrelevant to what role you're playing. A lot of credit at that point for standing there with the agents because we all know that they do push back a lot. They're very protective of what's going on and understand that. But again, to include them in the whole process, get the outcome that you've got. Amazing. And you've got an amazing tenant for a very long period of time now that are super happy with who's taken it over. What more could you ask for?
absolutely. And all the tenant wants is he wants growth. He wants to see that whoever's coming in is going to give him that growth and work in collaboration. And I got on the phone straight away. The minute I drove out there, I phoned the client and I said, man, we've got gold here. Because
Yeah.
the minute you see that problem, if you can solve that problem,
Yeah.
you've got gold. We've got a property that's got hairs on it, but
Yeah.
they're resolvable, with the right communication. So I'm going to give myself a little kudo ding for this morning's negotiation.
Absolutely. Go you. And so you should too. That's phenomenal. Yeah, well done. Love it. Absolutely love it. But there's the reality. So, you were talking about $1 million versus a $5 million property and what are the differences? For most of it, there are no difference, right? You've still got
100%
to go
not.
through the same process. The only major difference is the fear factor between $1 million and $5 million for an individual, right? You're still going to be looking for the same benefits. You're still going to be working with people. You're still going to have tenants. You've still got all of this, whether it be 1 million or 5 million. So you want to now look at quality and am I hitting my brief? What am I trying to achieve here? If I'm looking at retiring and I want an income of three or $400,000 a year, can I tick that off with a $5 million property? Or do I have to go and do five $1 million properties to do it? How much work do I actually want to create? And where's my risk tolerance?
I think the answer to that question that most people would be asking themselves is the fear factor would be in having a $5 million property that is vacant. Okay. And
Very, very true. But we touched on multi-tenancy, didn't we?
we touched
So
on multi-tenancy. So multi-tenancy is the way to go, or single tenancy. And I've got a couple of single tenancy properties as well, where I know that we start having those conversations, not necessarily the negotiations, but most certainly the conversations with the tenant a year in advance. And those tenants know that they're going to be, vacating or they want to stay on.
yep.
So
We've had those conversations and exactly the same. They know well and truly before they have to start those negotiations. It's a big deal. And I think if people understand how big a deal it is for a large business to actually shift location, they don't do it lightly.
and the
It is,
expense,
yeah.
massive.
Just go through the process of changing a postal address or if you have people that come into your business, changing that physical address, huge. It's a massive process they've got to go through. So they don't make that decision lightly and they don't do it overnight. So you're never going to find out with 5 minutes to sort something out and be vacant for forever because it's a very unrealistic thought process, but it comes from people that just don't understand and they haven't been given good information.
An example because we're busy dealing with a property like that at the moment. Now, we bought this property 2 years ago. We knew that the tenant was exiting. The tenant was very transparent. We went through the building, we went through, and the tenant has got massive, massive engineering machines in the property.
Yeah.
We're talking about almost double stories, massive, heavy duty machinery and presses and that kind of thing. The tenant is his budget to move is $450,000. He's got a budget between 450,000 to 500,000.
To
And
shift.
I was like questioning him. Wow, I thought that's pretty heavy. But then when we broke it down and we had a look at his office fit out, transportation, time, loss of earnings, shifting assets, shifting stock, all that kind of, it was huge because he's actually got to rebuild a certain portion of the business and pressure pumps and machinery and all that kind of stuff. So it was huge. It was humongous. And
Yeah.
that just gives you an idea how difficult it is to move a big business.
And it is challenging. So like I said, they don't want to move. They don't want to move randomly. And it's not a 5 minute process. There's good conversation around it. So sometimes it's not a bad thing to have a business that size, but it's a really good thing to understand where they're at in their whole process, what that actually looks like. National tenants don't tend to shift very often at
No,
all.
they don't. And that's why it is very good. We were talking about having money in the bank versus putting money in various different investments. And I wanted to just break that down. So we were looking at what are you earning right now if you've got money in the bank versus what can you earn if you've got it in various different investments. So what's your take on it?
I'm not a bank fan, never have been. They don't work for us.
Neither one of us are.
No, so at the moment, you might be lucky to get 3 or 4% if you're doing really well in the bank at the moment. If you were to leave money sitting in there, can you do better? Absolutely, you can. Thing is, though, we were talking about risk tolerance before,
Hmm.
and people see putting money in the bank as a safe option.
Yes, that's the
Mm,
thing. Is it a safe option?
I'm not so sure. I'm not convinced that it is. Right, it's not my gig. I'm not a like I said, I'm not a bank fan at that level. I think we can do better ourselves if we want to take control of what our financial wealth actually is.
Okay, so let's say we're going to break all of this down. We're going to look at owning your own property and getting into developments and all of that. So let's say if you're owning your own property, what can you be making right now and long term? Now, when I look at owning your own property, I look at a 10-year plan, all right? And I look at projections over 10 years. We do reverse cycles in order to do forward cycles. So what do you think a good yield is over 10 years owning your own property?
You make that really hard, Mish, because we go, and what's the range of what is our asset class? What are we actually doing? How have we leveraged it? Have we got signage? Have we got all these amazing things? Look, you could at a worst case scenario, if you were, very on the very low risk side of things and hadn't got creative at all, you'd sit somewhere around the 6-8%. You can push that up to 10, maybe 12%, maybe even 14% if you buy the right asset class and give consideration to what it looks like, but you'll be in the range of somewhere about that.
So that's it's in terms of risk. I'm going to say that
Mm.
probably is about medium risk. It's a little bit more responsibility. I mean, it's in comparison to having money in the bank. There's no responsibility to
Look,
just
there's
owning.
no responsibility to that. But if you went and found a tenanted property, a small little, sub-$1 million tenanted property, it had one tenant in it, very low risk, it's managed by someone else, and you got 6% for it, you're still doing better than what you're doing with the bank.
Exactly.
Right? And you've got an asset, you've got something that's going to increase in value, and you've got options that go with it. At the higher end of that, with a little bit more effort that you've got to put in and a little bit more creativity and maybe a little bit more money, you've pushed it up over a 10% return. But yes, the more you do that, the more effort you've got to put in up front, maybe a little bit more risk associated with a few more tenants or,
Yeah.
income streams.
And that would take you into your second strategy, which would maybe be an uplift strategy or a flip strategy. So if you're going to do uplifts, if you're going to do flips, you need to know what you're doing. You need to know where you're buying. You need to be doing your homework. So there's a lot more time involved. There's a lot more effort involved.
Of course
But
there is.
the outcome, you've done quite a lot of those. What? How's the outcome?
The outcome's very different, but it's relative to the effort you want to put in. So if you're prepared to put the effort in and take on a little bit more risk, and maybe you've bought some vacancy and you've put tenants in, and maybe you've added another income stream somewhere else, and again put the effort in to understand the market and buy in the right time and the right position and all of these things. Yes, there is more knowledge required, there is more time required. You've got to be on top of it. You've actually got to focus from the start of the process to the end of the process, but your yield's going to be different. You're actually going to get a bigger benefit for that. So again, at the lower end of it, maybe 8-9%, again, you can push that up to 15, 16,
20%. Yeah.
17, 20. Yeah. The
Getting
more
on.
layers you put on it, the better the yield is actually going to be for you. The better you understand your market and the better you buy, the better opportunity you've got to create a higher outcome. So it's relative to the effort you put in and your understanding of the asset class and the market that you're sitting in.
And the market, that's the most important.
Yep.
I always say the more doors that you have, the more money you're going to make.
Yeah,
Because,
yeah, sure.
the more doors you have, the more tenants you can have, the more value you can add. In
Absolutely. And while you're doing all of that, you're actually minimizing risk as well.
yes, you are. You are.
Right. Yep.
Look, it's a great strategy. I think it's a little bit more difficult. And like I say, you need to have a little bit more grit on your teeth to do that and more understanding.
You do. The minute you want to turn that into a flip, you've added another dynamic on that as well. So now you've got to be playing in the investor market. What are they looking for? What kind of cap rates are there? Where is my increase? Have I done everything I need to do to realize that increase? So again, you add on another layer of complexity. But you can hold half and sell half if you've done well. So now you can end up with no debt on half of it. But again, it's expertise, it's knowing what you're doing, another layer of complexity. So we have a bit higher risk, a bit more work, but again, very good return off the back of it.
Yeah, it's a great strategy. I mean, yeah,
Mm.
I love doing those strategies. I think I was born with tools in my hand, and
You were
my
Bob's
father was
builder
a
back then,
builder.
weren't you? Yeah.
My father was a builder, so I learned how to do all this stuff and have,
Yeah. Yeah.
you know, have done it many times, but it really is great. The other thing, I think the next platform to go to is developing. Now, a lot of people think, oh, there's so much more money in developing. Let's go and do a development. Let's join those development groups and do a development. I've kind of looked at it and gone, well, risk and reward, hello. I
Yeah.
feel the risk is tremendously high.
You're right, Mish. And I hear the same off a lot of people. And for some people, it's a natural progression. They just naturally go into it. But for a lot of people, they're caught up in that dollar figure,
Mm.
going, "Wow, there's massive returns." And I go, "There are massive returns, but if you want to spread it out over the years it took you to get there, can you make the same return year on year doing smaller deals, or do you want to get yourself caught up in the high risk, the complexity, the funding strategies you got to go through? Like now you're in a world of difference in comparison to buying your own, keeping it for an investment, great yields, totally different ball game. You
Yeah,
are
absolutely.
very heavy on strategy. You are very in amongst what's happening with the market. And it's a constant. You are now living this game. It's not a I'm doing this part-time. You are in it. So you've got to understand it. And I'd say to people, when you're going into development, do me a favor, don't do it for the money. Look at the impact you're going to have. Look at what you're building, creating, who you're working with, because there's a whole lot more to it than the dollars. And if you're not in it for the right reasons, it's going to hurt you along the way because it takes time. There's constant delays, there's resequencing and things that have got to be done, and you've got to be in it. You can't get part way through and decide it's not for you and walk away now.
Well,
Right. So you've got to be committed.
yeah, it's very interesting. I did a little bit of a project with a mate of mine a couple of years ago. He's a developer. I said I'm in commercial, and we had this debate over a couple of drinks. And I said, well, let's have a competition, okay?
Oh,
Let's do this. Let's do this. All right. Let's take the same value.
yeah.
It was 5 years ago, 4 years ago. We took $2 million, and I said, right, I'm going to do commercial, $2 million. You do a development for $2 million. I finished the commercial in 12 months and we made $1 million. He's still busy doing the development right now.
Yeah.
And he made
And,
zero. Okay.
and I can guarantee you, if you made $1 million in 12 months and he's still 5 years in, to top you, he's got to be up at the $6 or $7 million. Where is he? Right? Where is he?
Well,
And
that's the thing. Okay. So
so we
development,
talk about development. Development serves a purpose. I don't get me wrong, it does, but it's for the right sort of person.
it
You
is.
can't just jump into it and think that it's easy. It's not just a build. A development is knowing the strategies required in an area, being on top of the residential market if you're coming in with commercial, what sort of products required, who is the target market and the business is coming in for, who are my tenants going to be. And you got to know all that up front because everything is, we say, front end heavy.
It
So
is.
all of this happens at the front end. So there's a lot of time taken. You haven't even considered when you're going to actually start any form of groundwork or construction. There's a lot to do. So there's a lot of soft costs. You've
And
got
then
to fund it.
you've got all your players. You've got your architects and your designers and your builders and all of those moving parts. And I said to you earlier, if you're going to do a development, make sure that you've got really good, strong relationships with all of those parties for years, so that you know who they are, you know what their finances are like, you know that they're not going to fall over halfway through the deal. And I think that,
You've got to be strong. I think that if for anyone going into or wanting to go into development, you have got to have a strength in team. You have
yeah.
got to be the sort of person that can work as a team, hold a team together, and be very, very good at that relationship side of things because that's where you're going to spend most of your time.
Melissa, let's just talk about the returns on a development. When you're saying, yeah, you can make big returns on the development, really, can you really make? I mean, what are we talking about? I'm looking at maybe 15 to 20%.
Look, okay, so if I talk through that, there's a couple of things that when we do developments, we look at. And of course, you're looking at the return at the front end. I won't look at anything that is under a 20% as the bottom end of a return because so much changes along the way. So I want to know there's enough wiggle room in this. I also want to know that there's enough for me to give away because you need to. You will bring someone in on an equity share along the way that has an expertise in. So you want to know you've got flexibility built in from a return perspective. So if it doesn't have a 2 in front of it as the bottom end, I'm not interested. Now that's me and that's where I sit with it. I would like to think that from a return perspective, back end, without taking into account funding, that you are pushing well over your 30 to 40% because your funding is going to take a very big chunk out of that. So if we want to get down to net returns, you should be, as a net return after all funding, you should be sitting between your 20 and 30%. You don't, you are working for nothing. And people look at those numbers though, Mish, and they go, oh yeah, but your developers make a lot of money and go, well, you can if you do well, but you've also got to understand a lot of effort's got to go into it. And there are times when there's a chunk that'll come out of that because construction's gone up.
Yeah.
You've got to factor it in. You need to have your buffers.
And there's so many variables, along the way because it takes that much time. The market changes, your interest rate changes, your builders change, there are just so many variables along that way. And don't get me wrong, I'm not underselling development. I think They're very, very good development projects out there. I'm involved in them, in fact.
Yeah. I love development, but again, you've got to be a solution-based person to get into because you're right, so much changes. We've just sat down today, this morning, I was with our architects on a development project we're doing, and we're all so invested in it, so love it. It's a great dynamic with the team, and we're all very excited about what we get to deliver. But as things change, we're dealing with state government and what kind of grants can we get for this? Because now we've got to give consideration to the industry that we're in. How is that industry changing that we're developing for? And what does that mean? So you're constantly looking at who you are talking to, who you're networking with, what you're up against, and you've got to be in front of the eight ball. You can't be solving for problems after they've happened. You've got to be the solution coming in to make these things work. And it's not for everyone. Not everyone likes that and likes to live like it. So for anyone that's thinking about it, so just understand it. If it's for you and you love it, make sure you know your numbers, make sure you got an incredible team and understand it takes time. But if you're not that sort of person, commercial's amazing. I love commercial. Absolutely love it. And you can make every bit as much money in this space. You don't have to do development to make the money. You can make every bit as much as you've just shown. You can make every bit as much out of doing commercial deals as you can out of doing a development.
Yeah. So, I mean, we're looking at risk factor over here. So having money in the bank, low risk, no, very low returns. Doing your own commercial, medium risk. Doing high-end commercial, higher risk, great returns, unbelievable. Doing development, medium to high, depending on who your team is. If you're trying to do development by yourself, happy days, that's super high risk. So you
It's not a
really,
good idea.
it's not a good idea. No. The other option is doing development deals in joint ventures, and of course, the key element to doing deals in joint ventures in making sure that your joint ventures are either professionals in what they do, or they're money partners, or they're deal finders. So you're putting your elements together. And I mean, we were talking about that earlier. We've got joint ventures at the moment where we inviting equity partners to come in and join us. So in other words, put your equity into our deals and earn 22% per annum. 22%.
Now we know why people love you. Hey, show me that one. Yeah,
Show me the money, honey.
when you can stack a deal up like that and you can pay someone returns like that, you can give them an equity share of 22%. This brings great things together. Like they're great deals to be involved in.
They are. They certainly are. So I think that kind of we've really given a deep dive
Yeah.
and picked a lot of holes in commercial, in development.
Pay for that return, just one thing off the back of that, Mish, for that return, you can deliver a great return like that to someone. So 22% is a lovely return for someone to be earning to invest in a project that you're doing. You have the experience and credibility behind it. So for anyone going out there when they're looking to say, I want to do a joint venture, I want to be involved in, do your research on who you're getting involved in. Right?
Absolutely. No,
Know who it is. If you're putting your money into it, that's great because I've seen some incredible joint ventures done, some amazing partnerships that end up as great friendships, all of these things done exceptionally well. But we've seen that the other side of that too, where it doesn't work so well. So do your research, form the relationship. Okay, understand that what their experience is and have a look at that credibility because we want to make sure that you see it through to the end, that everyone comes out the back. But yeah.
do your homework. Find out,
Right.
really know who you're joint venturing with and who all the parties are, what the structure is. Very important to know what the structure is, what
Yep.
your risks are, because you're putting your hard-earned capital into those joint ventures. Somebody else is using your money. Yes, they're giving you a great return, but what are the risks involved as well?
Absolutely.
Yeah,
Mhm.
so do all of those. Lovely deep dive here, Melissa. We got to do this more often.
We should, shouldn't we? I know we said this last time. We have to. We have to do this more often. It's fantastic.
Well, guys, Melissa and I are talking about doing this more often. So if we can just find the time to get together, you might hear more of these exciting chats. Melissa, thank you so much for joining me.
Always a pleasure. Absolutely love it. Thank you for inviting me. I look forward to doing this again with you soon.
Okay, fantastic. Thank you very much. And guys, you know where to get hold of us. We've got all the details on revolvecommercial.com.au. And if you'd like to listen to this again, go along to the podcast. at revolvecommercial.com.au. The links are on there, and you can listen to this again and again and again and again and learn more.
Perfect.
Beautiful. Thank you, Melissa. Chat soon.
Thank you.